Hello guys, welcome to Power of Mindset Tools. In today's video we are going to look at how to differentiate the trend, which is the market structure, and traps in form of liquidity. Okay, we are on crash 500, and if we begin from here, you can see we are in a downtrend as long as this low was broken to the downside. Let's begin from here. You can see this high around here. There was a grab of liquidity as price dropped all the way from up, creating lower highs, lower low. Okay, lower high, lower low, lower low, another lower high, lower low, and the market began to range around here. When you reach here, we see a grab of liquidity in form of a fake out. Yeah, a fake out is when a price closes above the range, that is the high or low, and gets back within the range and continues the market direction. So a trap can be a wick or a candle closure. So if you observe this fake out, it created a double top. In Forex, a double top signals a change of trend, and in this case, a downtrend. So you see this double top is in line with the downtrend we are currently in. So the double top is supporting the trend, and therefore it's a grab of liquidity. Okay, if you look here, you may think it's a break of structure, but it happens often. So when you see this low of the double top or M pattern broken, you may look for entries on the retest, and that is where we can see the bearish engulfing pattern. And this bearish engulfing pattern becomes our surprise zone, considering the momentum our price left from there. Look at these bearish candles: 1, 2, 3, 4. Break of structure here to the downside, supporting the downtrend, and so you would mark the resistance on that surprise zone. But you can see price returned, grabbed liquidity, not only the first high but also the second, forming a 3-drive reversal. Look here, after grabbing the second high, it created a higher low instead of a lower low, because the lower low would be when price has broken this low but stopped here and went up. Okay, now you can see sometimes the grab of liquidity happens in what we call a 3-drive format. Let me show you how a 3-drive would look like. 1, 2, okay, 3, okay. Now this is what I'm meaning. You can see this is the first drive, meaning first high taken. Second drive, meaning the second high taken out. And third drive as the last high. Okay. Sometimes price behaves like this, creates something like a head and shoulder, then drops, okay, but sometimes it does not happen. So you can see what happened here: 1, 2, 3, and with a lot of selling pressure, price consolidates below the equilibrium, then takes out the low, which is a break of structure, to the downside, then comes back. When we come back here, we have relatively equal highs. That's money liquidity area that is expected to be grabbed in the future. So here I'm expecting price to clear all these seemingly trendline liquidity and those equal highs where the trend line begins from and stops from that rectangular resistance zone drawn, or continues up to clear all the liquidity, or that liquidity, those highs, up to the second rectangular resistance zone. When you come to weekly, you can see this doji candle has taken out the external liquidity and closed within the range. This is one of the candlestick patterns we use in Forex, especially when it occurs at the support zone and vice versa. And additionally, you can see the wicks, meaning rejections. Yeah, seeing these reaction within the range where the candle did close outside the range or below the previous low or wick, as you can see. I'm expecting price to push up, and moreover on lower time frame it has started hiking up. So the most important thing is to first look back at the latest historical chart, how price has been behaving. The moment the structure is broken, like in this case a low, begin looking at the entry levels. This could be at the neckline of the double top, like what happened here, but other times it happens in the premium zone. And another thing, the moving average can help when price closes below the moving average. So pay attention to rejections, reversal candlestick patterns like pin bar, doji candle, bearish engulfing, etc. But should be in line with the trend. Another thing, use a realistic risk to reward ratio like 1:2 or 1:3 according to your plan. So to effectively master traps in the form of liquidity, always mark the swing points and even highs and lows inside the swing points. So let me put the 20 exponential moving average and see how price reacted on it. So you can see a price closed above the moving average right here and formed this pin bar followed by a bearish engulfing candle. The rest was a rejection. Boom, price closed below the MA and continued dropping. Again, looking at the pin bar at the bottom or support zone was a demand zone. However, price violated it and took out the external liquidity, which means all stop losses below were wiped out, as we saw on weekly time frame. Okay, so let me go and check on H4 a time frame. After taking out external liquidity, price has formed a double bottom, and I'm expecting price to behave like this. So if you like this video, kindly subscribe, like it and share it. Until next time, peace and love. Right.